Welcome to the Tesla Economist. Please hit the thumbs up and don't forget to subscribe. I'm at a stage in my life where I don't want to risk it all. I appreciate everything I have, it's more than enough. I don't need to risk losing it by trying to be greedy to obtain that much more, such as selling everything I have and investing them all into Tesla Leaps. As stupid as that would be, what's the point if you're already content with what you have? Why risk losing it? Well, I actually want to be even more risk-averse than that. You see, I've borrowed a significant amount of money for my investments. At least that's one way to look at it. Personally, I see it as I've actually invested in debt. Okay, that's an interesting concept. I'm not sure I've ever heard anyone refer to debt as an investment before. Well, what am I talking about then? Right now, interest rates are historically low. They are nearly giving away money. You can borrow $100,000 and it costs you perhaps $2,000 a year on interest, depending on what country you live in. Now, if I put this $100,000 into Tesla, and Tesla went up just 20% over 5 years, then that would be $20,000 appreciation on Tesla, at a cost of $10,000 interest. Making money on other people's money, or getting high on OPM, as they say. But seriously, Tesla in 5 years up just 20%? Well, most of us are expecting that $100,000 to be worth something close to $500,000 in 2025. And if that $400,000 profit only costs $10,000 on interest, then that's an insane return. But that's investing in Tesla using debt, not investing in actual debt. So what do I mean by investing in actual debt? Is that I can see so much inflation on the horizon that I will likely not have to pay this money back at its previous purchasing power. The purchasing power of $100,000 might be closer to about $50,000 equivalent due to so much inflation. Or if this $100,000 Tesla investment has increased to $500,000, then I would simply need to sell 20% of the investment to cover the entire debt, excluding interest. But no one can see into the future. We never know what it might bring. And like I said, I'm not willing to risk my lifestyle. Therefore, when the time comes, when I think there actually might be blood in the streets on the way, and a real market crash is coming, I'm going to insure my Tesla shares. For those of you who don't know what I'm talking about, it's known as portfolio insurance. And I will do it with put options. Put options are the inverse of call options. In other words, if the stock price goes down, then you make money. Essentially, I think about what scenarios could really affect me. If there was a huge market crash and Tesla dropped significantly, and if interest rates also rose at the same time, I'd be in big trouble. That $2,000 a year interest could then become more like $6,000 a year. Now, my mortgage is actually quite a bit larger than $100,000, so it would definitely impact me. I like to think of certain scenarios that can affect me like this, and then bet on the outcome happening, and the most leveraged way possible. The bet is a hedge. The truth is, currently my Tesla shares are worth more than I currently own on my mortgage. But in this crash scenario I'm discussing, if I had put options, then they would increase in value dramatically. I actually wouldn't even buy enough options to cover my entire position, or even my entire mortgage. I'm thinking about buying enough put options that in this scenario, it might be enough to pay off half my mortgage, which will make it a lot more tolerable to deal with. Of course, in such a crash, my house would have lost value too, and would be hard to sell in such a market. I've been in this scenario before, from the global financial crisis. It's not a nice position to be, and I'm happy to forgo some of my Tesla profits in order to avoid it again. I may end up having to pay perhaps $30,000 a year or so in put options, but if Tesla is up around $1,500 to $2,000, then it's a small price to pay. It can just be offset by some of those profits. At least this way, I don't have to worry so much about a market crash, or have to run the risk of needing money so badly that I have to sell some Tesla shares, and in a market crash of all times. If Tesla has not crashed by the time my put options expire, then the loss should also be tax deductible as well. However, the gain would likely be too. I'm not sure when I might purchase these put options. It won't be until the market has risen a lot more, as that's generally the time before a crash happens. I don't think we've seen the usual insanity we see first before the market comes crashing down. Sure, cryptos were starting to look a bit crazy before, but they seem to have somewhat adjusted now. But it may be a crypto bubble that we see that spurs me to eventually hedge. And my timing may be off by a year or two even. But even still, if that's the case, then it would likely also mean the market is also appreciating significantly, and so is Tesla. I mean really, if Tesla hits $3,000 a share or something ridiculous, then I really would like to lock in a piece of that. It could truly be an EV bubble though, particularly with government catalysts like EV tax credits. I'm thinking it highly possible it might bubble the entire industry, and I'm not sure the government realise, or even the market. But these $10,000 tax credits are an enormous amount to be giving. There'll be definite consequences. Now, in no way am I suggesting you get a mortgage to buy more Tesla. I'm saying that I'm being risk averse. Even if Tesla didn't work out and interest rates rose, I have the income to cover the worst case scenario anyway. My mortgage is actually relatively low. It's only around 30 to 40% of the value of my house. It's because I managed to find an amazing deal for a house that needed a lot of work, and over a couple of years, I managed to add about 70% of the value onto it. There was quite a bit of risk involved in the deal, but fortunately it all worked out well for me. Of course, over the same period, my Tesla shares went up significantly too. So yeah, the last couple of years have been my best ever. But I'm not prepared to lose it now. I'm not suggesting this is something you should do. I just thought I would share what I am doing with some of you. And I may not even end up going through with it, or getting the timing right. But it's good to identify your weaknesses, anything that can be a threat to your investment, and try and do what you can to hedge against it. And you might even consider other stocks to buy put options for instead of Tesla that would suffer even more in such a scenario. Well, I did consider that too, and I bought put options on those when COVID happened, but they didn't quite crash as much as I thought. They only went up about 3 times in value, not the 20 or so I was expecting. I bought put options in the Las Vegas Sands Corporation, my theory being that as people couldn't travel due to COVID, then there'd be less gambling, and on top of that, there'd be less people wanting to be in casinos in crowds. And Tesla is my asset I want to cover. And if Tesla doesn't end up dropping that much in a crash anyway, then I'm still okay with the fact I lost a bit of money on insurance. I mean, we insure our houses in case they burn down. Why not our stocks too? This is just an idea I am considering, but this will likely be if things just get a little too crazy. It would be nice to lock in a slice of the money, so that if it did turn to a bubble and actually burst, then I'd still have enough left to cover my mortgage until the economy worked itself out again. But I can't see any signs of a crash just yet. I know there are famous economists predicting them by the week, although they seem to keep postponing them for another few months. I'm not saying that I can predict when it does happen, but I like to look for signs that I'm familiar with first. But this is how I see things. We all have our own ways to determine what sort of stages of a market we're in. Personally, I don't even think we've seen the real boom yet. I think there is a chance that Tesla could bubble too, with this new EV tax credit. If Tesla starts to hit $10,000, then I have no problem with a $50,000 a year insurance fee to lock in some Tesla with those sorts of returns, which also could potentially be that much more expensive if interest rates have risen. I just like to look around, evaluate my risk, and do what I can to mitigate the risk. And then, if there is no crash, when my options are coming up for renewal, I'll simply buy some more again, just like how you pay for your insurance each year. Thanks for listening. Please hit the thumbs up, and don't forget to subscribe.